You just got laid off, your heart is pounding. You are worried about your mortgage, your car payment, and how you are going to tell your family. Then you open the envelope from HR. It is your COBRA election packet. You see the number, $2,000 a month for health insurance. You were paying $300 a month when you had a job. Now they want 7 times that. Your first instinct is to panic. Your second instinct is to sign up anyway, because you have to have coverage. And that is exactly what the insurance industry is counting on. That panic costs laid-off workers thousands of dollars every single year. Some of them pay over $10,000 more than they have to. By the end of this video, you will know the truth about COBRA that your former employer will never tell you. You will learn the 3 hidden alternatives that can save you up to 80% on your monthly premiums. I will give you the exact deadline calendar so you never miss a critical window. And I will explain why COBRA is sometimes the right choice, but only in one specific situation. If you are losing your job or thinking about quitting, this video could save you more than $10,000 in the next 18 months alone. Let me start with what COBRA actually is. The name stands for the Consolidated Omnibus Budget Reconciliation Act. It is a federal law that lets you stay on your employer's health insurance plan after you lose your job. You keep the exact same doctors, the same prescription drug coverage, the same deductible you have already been paying toward. That sounds great, but here is the catch that most people do not see coming. When you were employed, your employer paid the vast majority of your premium. The average employer-sponsored family plan costs nearly $27,000 per year. You only saw about $6,000 of that in your paycheck deductions. Your employer paid the other $21,000. On COBRA, you pay 100% of the premium plus a 2% administrative fee. That means you go from paying $500 per month to over $2,000 per month. That is not a small increase. That is a financial gut punch. For a single person, the average COBRA premium is about $793 per month. For a family, it can easily exceed $2,300 per month. And here is the pattern interrupt that most people miss. You have 60 days from the date you lose your coverage to elect COBRA. And you have an additional 45 days after that to make your first payment. That means you can wait over 3 months before you pay a single dollar. During that time, if you have a medical emergency, you can elect COBRA retroactively, and it will cover you back to the date you lost your coverage. That window is a free insurance policy. Do not waste it by signing up immediately. Now here is where the real savings begin. The first and best alternative to COBRA is the Affordable Care Act Marketplace, also known as Obamacare. Losing your job-based coverage triggers a special enrollment period. That means you do not have to wait for open enrollment. You have 60 days from the date you lose coverage to sign up. The key is that your premium on the marketplace is based on your projected income for the year. If you are laid off, your income for the remaining months of the year is much lower than your full annual salary. That means you qualify for premium tax credits that can reduce your monthly cost to almost nothing. A family of 3 with a projected income under $40,000 can pay as little as $50 per month for a silver plan. In some cases, people pay $0. That is not a typo. $0 per month for full health insurance. But there is one critical warning you must hear. If you switch from COBRA to a marketplace plan, your deductible resets to 0. That means if you have already paid $3,000 toward your deductible on your employer plan, that money is gone. You start over. So if you are in the middle of expensive cancer treatment, or you have already had major surgery this year, Staying on COBRA might actually be cheaper even with the higher monthly premium. You have to do the math. Take your remaining deductible and compare it to the premium savings of switching. Sometimes COBRA wins. The second alternative is your spouse or partner's employer plan. Losing your coverage is a qualifying life event. That means your spouse can add you to their plan outside of the normal enrollment period. The cost varies. Some employers cover spouses at no additional cost. Others charge a few $100s per month, but it is almost always cheaper than COBRA. The only catch is that you have a much shorter window. Most employers require you to notify them within 30 days of losing your coverage. That is half the time of COBRA. Do not wait. The third alternative is short-term health insurance. These plans are designed to fill temporary gaps. They are much cheaper than COBRA, sometimes as low as $100 per month. But they come with serious trade-offs. Short-term plans do not cover pre-existing conditions. They often exclude prescription drugs, mental health care, and maternity coverage. They can also deny claims based on your medical history. These plans are best for young, healthy people who just need catastrophic coverage and do not take regular medication. They are a gamble. But if you are healthy and just need a bridge until your next job, they can save you thousands. Now let me talk about the hidden lie in every COBRA packet. The letter from your employer makes it sound like COBRA is your only option. They highlight the convenience. They emphasize that you keep the same doctors. They do not mention the marketplace. They do not mention subsidies. They do not mention that you have a 60-day window to shop around. That is not an accident. Your former employer has no incentive to help you save money. Their insurance broker makes money when you stay on the plan. The COBRA letter is a sales document disguised as a benefit notice. Let me give you a real example of how this plays out in real life. A software engineer in Washington State was laid off in March. His COBRA premium for his family was $2,100 per month. He panicked and signed up immediately. 2 months later, he heard about marketplace subsidies from a friend. He went to healthcare.gov and found a silver plan for his family for $390 per month. He had already paid $4,200 to COBRA. If he had waited just 30 days to compare his options, he would have saved over $3,000. That is money he will never get back. The same rules apply to people who quit their jobs voluntarily. COBRA is available whether you are laid off or you resign. The only difference is that if you quit, you may not qualify for unemployment benefits, but your health insurance options are identical. You still have 60 days to elect COBRA. You still have a special enrollment period for the marketplace. You can still join your spouse's plan. Now, let me cross the ocean to the United Kingdom because the rules are completely different. In the UK, private health insurance is a supplement to the National Health Service, not a replacement. If you lose your job and your employer-provided private medical insurance ends, you have two options. First, you can rely on the NHS. The NHS is free at the point of use for all residents. You do not need private insurance to see a doctor, go to the hospital, or have surgery. The NHS covers you regardless of your employment status. So for most people, losing private insurance in the UK is an inconvenience, not an emergency. Second, you can convert your group policy to an individual policy through a process called continuation of cover. Most UK insurers allow you to transfer your company plan to a personal plan within 30 to 90 days of leaving your job. This is often called Group Leaver or CPME, which stands for Continued Personal Medical Exclusions. The advantage is that you keep the same underwriting terms. Any pre-existing conditions that were covered under the group plan remain covered. But the cost will be higher. because you are no longer part of a group. A specialist broker can help you compare continuation options with new individual policies. Now let me finish in Canada. In Canada, every province has a public health insurance plan. In Ontario, it is OHIP. In British Columbia, it is MSP. In Alberta, it is AHCIP. These plans cover medically necessary hospital and physician services regardless of your employment status. You do not lose your provincial health card when you lose your job. That means you are never without basic coverage. However, most employer plans also cover prescription drugs, dental care, vision care, physiotherapy, and other services not covered by the province. When you leave your job, those extended benefits end. You have a few options. First, you can join your spouse's plan if they have employer coverage. Most plans allow this within 30 days of your loss of coverage. Second, you can convert your group benefits to an individual plan. Most major Canadian insurers, including Canada Life, Manulife, and Sun Life, offer conversion plans. You usually have 90 days from the date your group coverage ends to apply without medical underwriting. That is critical. If you miss that window, you will have to answer medical questions and could be denied or charged more. Third, you can buy a new individual health and dental plan from a private insurer. The premiums vary based on your age, location, and health status. But for most healthy Canadians, a basic drug and dental plan costs between $50 and $150 per month. Let me recap the key takeaways. Number 1. COBRA is not your only option. It is often the most expensive option. Do not sign up immediately. Number 2. You have 60 days to elect COBRA and 45 days after that to make your first payment. That window is free, retroactive coverage. Use it to shop around. Number 3. The ACA marketplace is almost always cheaper than COBRA for people with lower income after job loss. You can get a silver plan for under $100 per month with subsidies. Number 4. If you have already met most of your deductible for the year, staying on COBRA might be cheaper. Do the math. Number 5. Your spouse's employer plan is often the second best option, but you only have 30 days to enroll. Number 6. Short-term plans are cheap, but do not cover pre-existing conditions or prescriptions. Only use them if you are young and healthy. Number 7. In the UK, the NHS covers you regardless. You do not need to panic. You can convert your private plan to an individual policy within 30 to 90 days. Number 8. In Canada, your provincial health card never goes away. You have 90 days to convert your extended benefits to an individual plan without medical underwriting. Here is what I want you to do right now. If you have been laid off or you are about to quit, do not sign that COBRA election form. Go to healthcare.gov or your state marketplace. Enter your projected income for the year. See what your premium would be with subsidies. Then call your spouse's HR department and ask how much it would cost to add you to their plan. Compare all 3 options. You have 60 days. Use that time wisely. If this video helped you understand the truth about COBRA and saved you from overpaying, hit the like button. It helps more people in transition find this information. Subscribe and turn on notifications so you do not miss my next video, which is called The One Question You Must. Ask your HR before you quit, and comment below. Have you ever been offered COBRA? Did you take it or find a better option? Share your story and your country. I read every single comment. Thanks for watching. Now go save yourself thousands of dollars. See you in the next one.